Now, with global financial markets enjoying, of course, a period of relative calm, relatively speaking, and a great run for equities. Certainly the last few months, that's undeniable. Our next guest says investors have to still be vigilant when it comes to signs that that market could turn south.
George Lucas from Instreet is flagging oil and currency wars as two of the main risks. George, welcome to the show once again.
Thank you.
Good to see you this Monday.
Yeah.
You flagged oil. The financial markets seem to be worried about oil when it's kind of north of 110. It's sitting at about 105 right now. So what is the risk that you see from the oil price?
First thing is we have to realise that it's really at 125 or 126 because you've got to look at the Brent contract, not the West Texas.
Great point.
And so it is above 110. And then two, it is beginning to slowly affect. So we saw it slowly affect consumer confidence in the US. And obviously in euro, because the euro is now done at $1.30 rather than at $1.50 when it was at this last high level. You know, oil is a lot higher in euro terms, and so it's going to start affecting growth globally because it's going to have an effect of growth in Europe as well.
Isn't this priced in though, Marcus?
No, it's not really priced in yet, and they're beginning to price in. And everyone's talking about how it's only been small increases so far, but it was a 6% rise in February, 6% month on month in the US in gasoline prices, and we'll probably see another rise like that in February, which will start putting pressure on inflation. And then as people worry about inflation, they're going to sell off the long US Treasury bonds.
Is that, though, doomsday scenario, given what happened last week with Barack Obama and David Cameron? One of our earlier guests was saying there will be a moment where the strategic reserves are tapped. Do you agree?
There could be, because it's because we're in an election year, it could be tapped a lot earlier than normal because obviously...
All bets are on.
Yeah, all bets are on because it is a political... you know, gasoline prices in the US are obviously a very strong political factor, and they're going to try and keep them as low as possible, while at the same time he has to keep as much pressure on Iran. So he's actually in a quandary of what he can do.
Well, I mean, just on balance, is that a worrying precedent? Or do you welcome it?
I don't welcome it. It's just something that, you know, it's just the way the politics works, and it will just delay an issue probably until after the election rather than solve the issue. But I think oil prices are, you know, only about $10 to $15 is really due to the increased risk in Iran at the moment, and the remainder is probably due because everyone's upgrading their growth forecasts in the US.
We're nearing the end of the quarter. In just a few weeks, George, we've kind of survived. We didn't get the liquidity crunch in Europe that we were all fearing. In the next quarter, you say the main theme is going to be currency wars.
Yeah, I think
started to see it already.
We've started to see it, and Brazil came out very strongly on Friday, and they've put taxes on foreign investment, and they've come in and intervened in their market to keep the real down. Japan's one of the main reasons for them doing this quantitative easing was to get their currency down, and it's fallen down to fallen 5% in the last month against the US dollar. And, you know, honestly, I believe it'll be like the early 90s where we could see them try and depreciate their currency by another 50%. And, you know, in 92, 93, we saw the yen go from 80 to 120 against the US dollar very quickly. And they could try and do that to make themselves more competitive in the market. But that obviously affects the US because the US is a manufacturing-led recovery at the moment, and they're trying to, and at the moment they're quite competitive at the current exchange rates, and they can't really afford the euro to depreciate too much more and or the yen to depreciate too much more. So it's going to create a very interesting dynamic for the next 3 months.
And again, in a political election year for the United States as well.
In a political election year, and also when a lot of countries are politicising their currencies and making it a political issue rather than an economic issue.
Do you have a sense that that then is the tipping point for Ben Bernanke to move? That he gets the heavy put on him? Just as you say, it's election year, Ben. You know, so long as you're in this job, you'll actually deliver on request.
It could be
QE3.
Yeah, it could be a very heavy pressure point to put on QE3. I do not think anyone can ever believe that they're completely independent, these central bankers, and there will be a lot of pressure on them to bring in QE3 to get their currency down.
Because we should really be calling it a currency/trade war, because behind all of this is, as you say, the belief that manufacturing, if it's domestic, should be protected. I mean, Australia to one side, that's really what's at stake.
That's really what's at stake, and this change in mentality where people want to rebuild their manufacturing sectors, especially in the US.
You're actually less bullish about the Australian dollar the next 6 months. So is that
so we've been quite bullish on the US dollar, and we've called it, okay. But I think if because Japan's such a major trading partner for us, if it starts seriously devaluing its yen, or we see a serious devaluation of the yen, it will bring down the Australian dollar and much closer to par. And so we probably won't see the risk now. Is probably that it just stays in a trading range rather than if we were having this conversation 3 months ago where the risk was probably on the upside for the currency.
And are you pricing in alongside all of that QE3, or in your modelling, is that off the table?
No, I think QE3 will come back on the table because I think all these things have, we just have effects. So it's not a dynamic situation. So what we see is oil prices rise, the economy slows down, oil prices fall, they'll bring in QE3 to support the whole thing.
And then the dollar bounces back?
Yeah, and then the same thing, the US dollar will rise, the manufacturing industry will slow, the Fed will then have its excuse to bring in QE3 and get the currency down.
A quick one, George. You're saying, I just see a line in your report, you're going to reevaluate the situation, consider whether you remain long equities in August.
Yeah.
So does this have anything to do with the timing of that call, August?
August, yeah, because the markets it'll take a little bit of time for all these influences to come through. They're not going to happen instantaneously, and it can't, governments and economists will evaluate everything before they bring in, and so we wouldn't expect them to around August, September to start actually seriously thinking about these type of policies which could be
Jackson Hole, again.
Yeah, which could be counterproductive to the economy. That's exactly right.
Okay.
They actually really only occur in March and September. If you actually look back in history, they really only ever do.
George, long-term calls, pretty ambitious to make them. But listen, we'll have you back next week.
But I have no long-term. It's just long equities at the moment, but you really want to be cautious.
Perfect. George, thanks so much.
Advice. Thank you.
For now, thanks. Yeah, and coming up as well, the Australian dollar has staged